Welcome back to Ostrich Investing. So I guess we should probably be talking about GameStop, which, wow, what a crazy week in the markets last week. But you know what? No, today we're going to talk about 4 stocks that have been recommended by you. I'm going to give you my quick take on Telus, Fortis, Vermilion, and Atco. Let's jump into it. So if you're new to the channel, Ostrich Investing is all about investing in the stock market, including discussion on specific stocks. Join us. Believe it or not, it's free. Quick disclaimer before we get started. This is not financial advice, so do your own research. And disclosure, I do not own any of the 4 stocks we're going to talk about today. So Telus, we'll jump right into it. Many of you probably already know this one. 15 million plus customer connections across wireless, internet, TV, voice, and security. So it's one of Canada's largest telcos. And you can see here with 10 million of those customer connections in wireless. Wireless is a very large segment for Telus and accounts for 65% of consolidated EBITDA. On the cash flow side, you can see here on the top right of the screen that cash flow from operations has been sort of steady at the $4 billion a year mark. And this type of business, as you would have seen in our video on BCE, is heavily capital intensive. So there's lots of CapEx historically, and there's also some acquisitions for Telus historically that have essentially reduced free cash flow. Dividend payout ratio is hanging in steady at about 80%. So on the higher end of the range, they're paying out most of their earnings. And leverage is reasonable. It's sort of crept up to 3.2 times debt to EBITDA as of the end of 2019. But for a business like Telus, that's fairly reasonable. On the bottom part of your screen, you could see revenue and EBITDA, and you can see nice, steady, growing EBITDA over the last 5 years. And then over on the right side, you can see growth in dividends per share and earnings per share over the previous 6 years. So if we look at the share price chart, Telus stock is up about 30% over 5 years, plus you're getting the dividend. It recently, one of the recent changes, it's announced registration to IPO Telus International, which is a business process and IT solutions subsidiary. The expected valuation of that is about $7 billion. So if you're an investor in Telus or you're looking to invest, you want to check out how that IPO is going and what effect it'll have on Telus overall. The current valuation for Telus is 9 times next 12 months EBITDA, or about 25 times earnings. Considerations. All right. So strengths. It's a large telecom provider in Canada, and it's in a regulated industry, which gives it pretty stable, growing revenue, cash flow, and dividends and reasonable leverage, as we just showed. Telus Health and Telus International. So they've got some other subsidiaries or other segments that they're focused on growing. That provides a bit of a differentiation versus some of the peers like BCE and Rogers. So, for example, Telus Health, they're trying to build out a segment that helps with the digitalization of health records in Canada. That, assuming they're successful, could be quite meaningful. And I think Telus is also reasonably acquisitive. They have a venture capital arm. They have a few other things there that they're doing some other things that are different than BC and Rogers or a pure play. Lastly, on the strength side, tailwinds in wireless and internet usage, 5G, Internet of Things. Again, we talked about that a little bit in our BCE video from last year. So if you want, go ahead and take a look at that video. Risks, regulators, we got a shout out to Warren G at the bottom here. This is, in my view, the biggest risk to the stock. There's a hot political topic, as we know. The Liberal government is keen on trying to find ways to reduce the cost of wireless for customers across Canada. And CRTC, which is the regulatory body, has been and continues to look at increasing competition in that area. So TBD on what ultimately happens, but obviously more competition is likely net to be, not be great for Telus. So just something to keep an eye on. Significant CapEx requirements. again, as they're laying fiber and increasing the network speeds, it takes a lot of capital. So while the business does generate nice free cash flow, they're constantly having to reinvest in the business. Again, on the risk side, it's sort of a strength, but also potentially a risk is, are they able to grow these healthcare and ag platforms that they're trying to build out? There's really not much info that I could see readily available on these. I think they're quite small right now. If they're able to do that, I think they've got a great differentiator, but as a risk, it's early days here. And then of course, cord cutting and declines in the legacy businesses. So quick thoughts from me. It trades at a slight premium valuation to Rogers and BCE. So I think that's my guess would be it's likely based on the potential growth in Telus Health and Telus International and obviously the impending IPO there. I think, as an investor, you want to decide why Telus over BCE or Rogers. And BCE is the largest player in Canada. So that might be, one reason why you'd want to own BCE. Telus has these differentiated business segments and might be the reason why you'd want to pick Telus, but that's up for you to decide. And then quickly here on social capitalism, this is a big part if you look at their annual report. This is something that management's focused on, and we know it as ESG gains a lot of traction for many institutional investors. This is something that Telus is trying to play into. All right, up next, Fortis. So we got to give a shout out to Newfoundland. They're headquartered in St. John's, Newfoundland, all the way over on the right side of the map. You can see it here. It's part of their operations. Fortis is a regulated utility, generation, transmission, distribution of electricity and gas. They've got a long track record of earnings and dividend growth. You can see their assets here across North America. And again, a lot of it's regulated electric, regulated gas, FERC regulated electric transmission, mostly in the US here. And then they've got some long-term hydro generation assets as well and some natural gas storage facilities. But takeaway is it's a regulated business. So we talk about the base rate being the assets that they're earning on. They've got $28 billion as of the end of 2019. I think that's increased since then. 47 years of consecutive dividend increases, and like they said, majority of earnings coming from regulated utilities. Okay, so if we look at the stock price chart, I made an exception here. We're not looking at 5 years. I took it out 25 or 26 years here. We're going back to 1995, and what a stock chart. This is a fun one to look at. 9% compound annual growth rate just for the share price alone over 26 years. And the dividend currently 4%. Add that in, you've got some spectacular compounding going on for investors who've held this for a long time, which in my view puts Fortis in the GOAT conversation for Canadian dividend payers. And has me asking myself why I haven't owned this one in the past. It's definitely been great and rewarding for shareholders. One quick thing I wanted to point out, in 2016, they made a big acquisition, transformational acquisition. If you saw from the map on the slide before, a lot of their US assets were acquired back in 2016 with the $11 billion acquisition of ITC Holdings. And that was a big one. I think back then they were sort of doubling the size of the company, and they took on debt and they issued equity, and obviously management's executed. So you've got to give them credit for that. All right, one more chart here just on the dividend growth. I thought it was important, just given how well Fortis has done historically. We got Albert Einstein talking about compound interest being the eighth wonder of the world on the left, and you can see it on the right hand of the slide here. Dividends per share going back since 1972, and it's just been great growth. The one thing I'll point out is the payout ratio, which is this orange line here. It's a little bit deceiving. In 2019, it shows that it's dropped down to 50%, but I think they'd sold some assets in 2019, so more normalized. And if we look at it on a 2020 basis, the payout ratio is likely closer to 80%. and based on forecasts, it may drop down to 70% in 2021. So the payout ratio is in that 70 to 80% range. But some quick stats here: Fortis dividend is up, 5 times over, I think, the last 5x over the last 26 years. And if you had put $1,000 in 20 years ago, that's almost and reinvested the dividends. So from a total return basis, that's worth almost 14K today. So 14x on your investment. So it just goes to show that compounding, it's easy when you look back in hindsight, but slow and steady can be great, right? 9% share price appreciation on average per year, plus the dividend. That's a really nice recipe for attractive returns for investors. All right, so considerations. Warren Buffett says never bet against America. Maybe he should be saying never bet against Fortis. Strengths. It's a regulated business, provides stable revenue and cash flows, particularly electricity transmission. Management's got a great track record of execution, shown that they've been able to grow both organically and via acquisition and execute those acquisitions well. And nice dividend of 4% while you wait. And again, payout ratio is about 80% this year. Risks, and I'm not a huge expert in regulated businesses, but it comes down to their ability to continue to increase their rate base. And they have a great presentation that talks about their 2021 to 25 growth plans, and they're hoping to grow their rate base by 6% a year, which is going to support their projected dividend growth of 6% per year over the same period. So that's really what it comes down to is, can they continue to grow their rate base through both maintaining the assets and adding incremental growth? But you need buy-in from the regulators. And this all sort of results in a $20 billion capital plan through 2025. And that's what's going to drive the growth for Fortis going forward, assuming they can execute on it. 2020 adjusted EPS is actually down versus 2019. So, we look at these regulated companies and stocks, and you think earnings can only go up. That's not the case. It's not fully insulated. So that's one of the reasons why I guess the stock has traded off a little bit recently. Another risk: headwinds on the fossil fuel side. It's 5% of assets, so I'm probably stretching a little bit here, but just something to be mindful of, as we know that fossil fuel generation is looking to be phased out, and the question is over what time period. And then lastly, debt levels. Business like this, as you'd probably expect, has a lot of debt. $25 billion is about half of its enterprise value, and about 6 times EBITDA. So rising interest rates would provide a headwind here for the business. So my quick thoughts: trades at 20 times earnings, which doesn't seem too demanding, especially for a business of such high quality and one that has the track record they do, and compare it to the current low interest rate environment. So 4% dividend to me is relatively attractive. I did take a quick look. Valuations in the historical range. So it's not like it's cheap relative to where it's traded over the last, call it, 5 years. So take that for what it's worth. Again, management execution here has been impressive. Rate base and regulatory compact. So this is something, again, I'm not an expert here, but you want to look, and you can see it in their investor presentations, what return on equity they're allowed to earn on the various assets that they have across North America. And it's kind of in that 9 to 11% range that they're able to earn on their assets. And of course, there's a percentage of equity that's allowed to. So how much is equity funded versus debt? So there's sort of a calculation that goes on. And if you own Fortis or looking to buy Fortis, that's something you want to be comfortable with, because that's ultimately what's driving the earnings growth. And lastly, lower growth. As we saw in the charts, that's okay if it's nice, steady, 6-10% growth per year. That can work out to great returns over time, but it ain't no Shopify. It's not going to get investors up out of their chair. They're projecting sort of that 6% dividend growth over the next 5 years. All right, Vermilion. Okay, Vermilion. Keep going back to Canadian oil and gas. Vermilion's interesting actually because while it's listed in Canada, they have a lot of assets that are outside of Canada. So if you just look here on their production for 2021 E, this is from I believe their most recent investor presentation. You can see that they've got oil that gets Brent prices. They've got some European gas assets, and they've got some North American gas assets, and then they've got some other oil that sort of gets WTI type pricing. So a blend of, a mix of North America and European assets. And you can look below here on the pie chart at the bottom of the slide. If I can get my mouse going, here we go. You can see the share of production drives different profitability. So gas and the oil on the Brent side, has outsized contribution to their funds from operations. Up on the top right, this shows their production history going back many years. So it's a nice slide from, I believe, again, their investor presentation. And in red, it highlights international production, and blue is North America. You can see, obviously, that in 2020 and 2021, they're seeing production decline. So expecting production of 85,000 barrels of oil equivalent per day, which is a decrease over the peak in 2019 of close to 100,000 barrels of oil equivalent per day. And lastly, and a big part of the story here, and we'll get to the dividend cut as well in a minute, is leverage. So their net debt to EBITDA is outside of their targeted level. The balance sheet's in somewhat rough shape here. And so that's one of the reasons for the dividend cut, and we'll talk about that in a second, is they're trying to get their balance sheet back into the right spot. But right now, leverage is high. Okay, so here's the share price chart over the last 5 years. Vermilion shares are down 90% from late 2016 highs. That's painful for me just to say it. In February 2020, the stock price line crosses into the volume part of the graph, so that's never a good sign when the share price on Yahoo goes so low that it's in the volume part of the graph. And then in April 2020, and probably no surprise at that point, given what happened last year with oil prices and COVID, Vermilion finally made the tough call and suspended their monthly dividend. So considerations for Vermilion: strengths. It's a mix of oil and gas production, and it's got some international diversification. So really nicely diversified asset base, if you want to call it that. It's not a pure play Canadian oil and gas play. Come on. And Brent exposure has historically provided higher average realized selling prices. So here, if you remember back in the last few years when the Canadian production was selling at a huge discount to WTI and Brent, well, Vermilion, by having some assets that get Brent pricing, was able to stick handle around that a little bit and get overall better pricing than some of its other Canadian listed peers. And I put here as a strength relatively cheap. I'd need to do a lot more work, but one thing that they try and point out in their investor presentation is from a PNAV perspective, or a blowdown of the assets perspective, that they're incredibly cheap. I need to do more work. It makes sense because I imagine, if you look at the share price for Vermilion and the dividend cut, it's probably a stock that has just been completely washed out. But something to consider. Risks. Okay, leverage we talked about a little bit. Total debt has climbed at Vermilion from less than $1 billion in 2013 to over $2 billion currently. Their covenant, they have a 4 times debt to EBITDA covenant that, as at September 2020, was at 3.2 times. So they are, getting close to their financial covenants. That being said, they've cut the dividend now. They've brought CapEx in line. So I would expect, barring another major fallout in oil prices, that they will be able to bring their leverage back in over time. It may take quite some time, but by not paying out the dividend, and reducing capex. As you can see, their production is going to go down in 2021. They're just trying to right size the balance sheet, and so I expect they'll be able to do that, but it'll probably take some time. Again, just mentioned it, decreasing production profile while the company focuses on repairing its balance sheet. And Vermilion does say that they want to return to paying a dividend at some point, but it might be a while. So if you're in it for the dividend, you could be waiting for quite some time. So my quick thoughts, capital, this is kind of a case study in poor capital allocation. I will caveat my comments that it's really easy for me to sit here and say that in hindsight. Pretty tough to predict how rough things were going to be in oil and gas markets over the last 5 years, particularly for Canadian producers. And I know, Vermilion has some international assets, but the majority is in North America. But ultimately, years of payout ratios greater than 100% drove the increased debt levels and sort of got them into a tricky spot with their balance sheet. If you're looking at owning Vermilion, decide why you want to own it. There's lots of energy producers, oil and gas producers out there, particularly listed in Canada. So why would you want to own Vermilion? Well, maybe you like the international assets. You like the differentiation versus some of the pure play, Canadian producers. You get exposure to European gas and some Brent oil pricing. And so if you had a view on those, maybe this is a stock to consider. But obviously, Vermilion's had a tough go over the last few years. They made the tough choice to cut their distribution, and key priority for them is getting their balance sheet back in shape going forward. Last, but definitely not least, we are going to talk about Atco. So Atco is controlled by the Southern family, which has Atco itself has a controlling interest in Canadian Utilities, which some of you might be familiar with. And Atco also owns other assets, including Atco Structures. So think like storage modular structures that you can rent for construction projects, etc. And you can see down below that there's other assets like a share in Neltume Ports. And just quickly here, one thing to note with Atco and Canadian Utilities is they have a significant presence in Alberta. So Canadian Utilities, just quickly about them. Back in 2019, they sold off the majority of their fossil fuel generation businesses, so some coal and natural gas power generation in Canada. They sold that off in 2019. And now the majority of the earnings come from the regulated utilities. So you can see here, electricity transmission, electricity distribution, natural gas distribution, transmission, and some international natural gas distribution. So electricity and natural gas, and Alberta is a big part of their business. So if we look at the share price, Atco shares are essentially flat over 5 years. They currently trade at 13 times 2020 earnings per share, and they offer about a 5% dividend yield. So here you can see the drop off in February 2020, and back in 2019, this is when they sold off their fossil fuel generation assets for $835 million. That was back in May of 2019. So considerations for Atco: stable underlying business with a long track record and some nice, meaningful insider ownership, 30% plus from the Southern family. Nancy Southern's the CEO. Also structural control of Canadian Utilities. So if you own Atco, you've got a 52% interest in Canadian Utilities. Company, Atco's got a long track record of dividend growth, 28 years. So also very impressive. Not quite at Fortis levels, but getting there. And international growth projects and diversification. So if you look at their investor presentation, they've got some projects outside of Alberta, outside of Canada, that they're looking to diversify into. So that'd be something to track. Risks, Alberta exposure, and not sure how much of a risk that is, but the market clearly right now is not loving anything in Alberta. We talked about some of the REITs or real estate companies that have exposure to Alberta. I think probably the same for Atco with Canadian Utilities and the Alberta exposure. That's probably a risk or something you want to think through. Natural gas distribution and transition headwinds. So again, this goes to the cleaner renewable energy future. I would think that natural gas is going to play a big role in the transition to cleaner energy. But it is up for debate. I think as we transition away from coal, natural gas probably has a great role to play in the medium term. Because if you just look at the power grid, the amount or percentage that comes from coal and natural gas is meaningful. And I don't think it's something that's going to go away anytime soon. But that's a discussion, and that's for debate. Low historical returns on capital of about 5%. Now, again, you'd expect lower returns, and on the equity side, returns on equity are a little bit higher. But just something to note here. This is, their business model. It's not a high return on capital business. Leverage, again, nothing really stood out to me as, for the type of business they're in. They're probably in that 5 to 6 times debt to EBITDA range. So nothing stands out to me given the type of business they're in, but just be aware, obviously, there's lots of debt on the balance sheet. And lastly, ESG transition. I like what Atco's done here. They sold the fossil fuel electricity generation business back in 2019. That was 2,300 megawatts. So they've made a decision to move away from, a big part of their fossil fuel business and into cleaner and regulated assets. So thoughts, as a value investor, I got to admit my juices are flowing. I like this. There's structure. They sit at the top of the house. They control Canadian Utilities, plus they've got some other assets. Governance be interesting. I really like the strong insider ownership, but note that the X shares, which are likely, those are the ones that you're going to see quoted, they are non-voting. So you're sort of along for the ride here. You don't have a vote or a say. Current share price is interesting. It reflects, basically, if you look at the 52% interest in Canadian Utilities, what that's worth based on what Canadian Utilities is trading at is essentially equal to Atco's market cap. So you're basically getting everything else for free, all of those other divisions. Again, as a value investor, that's interesting. That being said, I did take a quick look, and valuation multiples, whether it's, price to earnings or EV to EBITDA, they're more or less in line with historical averages. So it's not, I'm always careful. It's cheap. It looks cheap. But it kind of has been cheap over the last 5 years. So you want to be careful you got to know as an investor what's the catalyst or what might change. But that being said, maybe you don't need it. With a dividend yield of 5%. So those are some quick thoughts for investors, for people who own Atco or people who are looking at it. So that's it for the video. I'd love to hear what you think about this format with some quicker thoughts in a few names versus more in-depth videos on one stock. But until next time, happy investing, stay safe, and don't bury your head in the sand.